Welcome to Iron Financial, the place where we forge stronger portfolios and cut right through market weakness. Today, we're putting Gap Inc. on the anvil. For decades, this company was an absolute cornerstone of American retail, a name literally everyone knew. But in today's market, legacy can be a liability, and let's be honest, nostalgia doesn't drive shareholder returns. So we are here to ask a very simple, very brutal question. Is Gap built to last, or is it just a house of cards, just waiting for the next gust of wind to blow it all down?
Okay, let's dive right into the heart of the matter, because this is the paradox that has Wall Street buzzing. Gap reports its fourth quarter earnings. Now, on the surface, everything looks clean, really clean. Revenue hits the target exactly where the analysts wanted it, earnings per share right on the mark. By all accounts, this should have been a solid, predictable, maybe even boring quarter. And yet the market's reaction was anything but. It was swift and it was brutal, an 8% drop in the stock price. And that just doesn't add up. So what's going on here? The blueprints say the building is totally sound, but all the inspectors on the street are running for the exits. That tells me the market sees something that the headline numbers are hiding. The market is basically screaming that this is all just a facade, that there's a much weaker reality just underneath the surface. So the big question for everyone watching is the market right, or is it overreacting, and in the process, creating a powerful buying opportunity?
That's exactly it. So today we're going to conduct a full structural inspection of this company. We are going right down to the studs. We'll start with that very paradox we just talked about. Then we'll examine the foundation and the load-bearing beams of their brand portfolio. After that, we'll look for any cracks in the armor. We're talking specifically about profitability. And then we're going to isolate the single biggest liability, what we're calling that rusted anchor, Athleta. Then we'll stress test their ultimate defense, a fortress-like balance sheet. And finally, after all that, we'll issue our verdict. So let's get to work. So let's start where any good inspection does, with the foundation. Before we can even begin to look for cracks, we have to understand what the company is actually built on. And when you look at the top line numbers for this quarter, at first glance, I have to say, this foundation looks absolutely rock solid. Let's get into the raw data. Okay, now what's really fascinating about this slide is the precision. Just look at these numbers. Revenue came in at $4.24 billion, exactly matching the Wall Street consensus. Not a dollar over, not a penny under. Dead on. And earnings per share? 45 cents, right on the nose. Now, in a market that savagely punishes even the slightest miss, this is exactly what you want to see. Management set a target, they communicated that target to the street, and then they delivered. They hit it perfectly. Based on this evidence alone, there's absolutely no logical reason for an 8% sell-off. It just doesn't make sense. And this isn't some one-off fluke, not at all. This slide here shows us a really powerful trend that's been building for years now. We're looking at 8 consecutive quarters of positive comparable sales growth. That is 2 full years where quarter after quarter after quarter, they have demonstrated consistent growth. This isn't a company that's scrambling to find its footing. This is a company with a proven track record of bringing customers back in the door. This should be the very bedrock of investor confidence. It's like a solid, reinforced concrete slab that you can build a strong bull case on. Okay, 2 years of growth, I get it. It's a nice, steady trend, can't argue with that. But you and I both know growth can hide a multitude of sins. It can easily mask deteriorating margins, a weak balance sheet, or a failing part of the business that's being propped up by the others. So if the foundation is really this solid, why is the building shaking? What are we not seeing? That is the right question to be asking. So let's move up from the foundation and start inspecting the core structure itself. A company like Gap Inc. isn't a monolith. It's really a portfolio of distinct brands, and each one of those is supposed to be a structural beam holding the whole thing up. For the entire enterprise to stand tall, these beams need to be strong. We have to figure out which ones are solid steel and which ones might be starting to buckle under all the pressure. And this table right here illustrates the dynamic within the portfolio perfectly. Look at the namesake Gap brand. A roaring 7% comeback in comparable sales. The CEO, Richard Dixon, says the brand is firmly back in the cultural conversation. And you know what? These numbers don't lie. Then you have the workhorse, Old Navy, up a very reliable 3%. This is the volume driver, the brand that really pays the bills, and it's consistently performing. Heck, even Banana Republic is pulling its weight with a respectable 4% gain. So 3 out of the 4 main beams here look incredibly strong. So as you can see, the core brands, Gap and Old Navy, they are the heavy steel I-beams holding this entire structure up. They are carrying the load and then some. They're doing the heavy lifting. But hold on a second. I'm looking at this chart and my eyes go right to that big, ugly red bar. What in the world is going on with Athleta? A 10% decline? You can't just brush that off. That's not some little hairline crack. That looks like a major structural problem. That right there is the first real red flag that tells me something is seriously wrong under the surface. Exactly. Top-line growth is great, but it's pure vanity if the cost of achieving it is eating you alive from the inside. It's like building this beautiful, shiny skyscraper that's secretly rusting from the inside out. We need to look past the shiny revenue numbers and see what's actually happening to the profits. Are they forging stronger earnings, or is the armor actually riddled with cracks? So you hear the confidence from the CEO, Richard Dickson. Another successful fourth quarter, he says, meaningful progress. And look, based on the sales numbers we just saw at Gap and Old Navy, you can kind of see his point. But the real question is that progress actually hitting the bottom line? Let's contrast that public statement with the numbers Wall Street really cares about, the numbers that determine if this progress is actually profitable for shareholders. And here it is, the first major crack in the armor. Look at this year-over-year comparison for earnings per share. A year ago, in the fourth quarter of 2024, they earned 54 cents per share. This quarter, it's down to 45 cents. That is a significant drop. It tells us that even though they are selling more clothes, the company is actually less profitable than it was a year ago. It's a crystal clear sign of margin pressure. And what that means is it's costing them more and more to make every single dollar in sales. And here is the source of that pressure. This is the smoking gun. Gross margin fell 80 basis points, from 38.9% all the way down to 38.1%. Now, to be fair, the company was very clear about why this happened. They faced a massive 200 basis point headwind from tariffs. You should think of tariffs as a corrosive agent, like salt on a car, actively eating away at the steel beams of the company's profitability. They did manage to offset some of it with better inventory management, which is good, but the damage was done. Look, this isn't necessarily management's fault, but it is absolutely their problem, and it's a big one. You've absolutely hit on a crucial point of weakness. The margin compression is real, and it's being made so much worse by the one brand that is failing to perform on every single level. So it's time to isolate Athleta and really examine just how much damage it's doing to the whole company. This isn't just a weak beam at this point. It's a rusted anchor that is dragging on the entire enterprise. A double-digit decline is an absolute disaster in the world of retail. While the core brands are firing on all cylinders, Athleta is in a complete and total freefall. Management themselves describe the sales trend as disappointing. That's corporate speak for it's terrible. This isn't just a crack anymore. This is a fundamental failure in a key part of the business strategy. And it gets worse. It's not like they're telling us they see a quick fix on the horizon. They are forecasting continued negative mid to high single-digit declines for Athleta in the first half of 2026. So they're basically telling us the problem is going to persist. This anchor is heavy, it's rusted through, and it's not getting any lighter anytime soon. So the question becomes, can they cut it loose before it sinks the whole ship? Okay, so let's just recap where we are. We have serious margin pressure from tariffs, and we have a failing brand in Athleta that's just bleeding sales. This sounds pretty bad. The operational concerns are completely valid. There's no question about it. But this is where the story pivots. See, a building with cracks can be repaired if you have the capital, the tools, and the conviction to do the work. So let's shift our focus to the company's ultimate defense against all these problems, its overwhelming financial strength. Gap has built a fortress of capital. $3 billion in cash and equivalents. Just let that number sink in for a moment. This isn't just a healthy cash position. This is a war chest. The company reported this is their highest cash balance in nearly 2 decades. This gives them immense, almost unbelievable flexibility. It's the capital to make all the necessary repairs, to double down and invest in the winning brands like Gap and Old Navy, to weather any economic storms that might come along, and to absorb the costs of fixing the mess that is Athleta. This is their ultimate defense, and it gives them the resources to reinforce any weakness they have. Right, and you have to look at what they're doing with that cash. A company that's truly in distress, a company that sees a collapse coming, protects its cash at all costs. They cut the dividend, but Gap did the exact opposite. They raised the dividend for the first quarter by 6%. That's a direct signal from the board of directors to shareholders, and it's basically them saying, we see the problems, we understand them, and we are so confident in our future cash flow that we're going to give you a raise anyway. That's a powerful vote of confidence from the people who know the most. And if the dividend hike wasn't a strong enough signal, they authorized a new $1 billion share repurchase program. This is perhaps the strongest signal of all. It means management not only has the cash to fix the problems, but they have so much conviction in their own strategy that they're taking $1 billion to invest heavily in their own stock, especially after an 8% drop. They are effectively screaming at the market, "You are wrong about our stock, and we're willing to bet $1 billion that we're right." That, my friends, is conviction. All right, the inspection is complete. We've seen the good, we've seen the bad, and we have definitely seen the ugly. We've examined the solid foundation, the steel beams holding things up, the rusted anchor dragging it down, and that fortress-like balance sheet. So now it's time to weigh all the evidence and deliver our final verdict. Is this an opportunity, or is it a trap? So let's get right back to that central question we started with. Why the 8% drop? It all comes down to one word: guidance. The market doesn't care about last quarter, it only cares about next quarter. And what triggered the panic was the company's weak guidance for Q1 of 2026. Specifically, they forecast that gross margins would fall by another 150 to 200 basis points, again, driven by those tariff headwinds. So the market heard, more margin pain is coming, and it smashed the sell button. It was a purely short-term, almost knee-jerk reaction. But here is the twist, and honestly, this is the most crucial part of our entire analysis today. While the market was panicking about the next 90 days, it completely missed the bigger picture. Look at this slide. For the full fiscal year 2026, Gap is projecting earnings per share between $2.20 and $2.35. The Wall Street consensus was only $2.15. That's a solid beat. For revenue, they guided to between $15.7 and $15.9 billion. Well, the street was only looking for $15.4 billion. That's another beat. What this tells us is that management believes the margin pain is temporary. The market sold the short-term story. It completely missed the long-term opportunity. So let's lay it all out one last time. The bear case, the argument for a potential collapse, is clear, and it's all focused on the immediate term. You've got severe margin compression from those tariffs, you have the persistent drag from the unmitigated disaster that is Athleta, and you have that weak Q1 guidance that sent investors running for the hills. These are real, tangible risks. They absolutely are. But the bull case, the argument that this structure is fundamentally sound, is arguably stronger and much more forward-looking. You have two powerful core brands driving real, sustained growth. You have a fortress balance sheet with $3 billion in cash. You have confident shareholder returns through dividends and that massive buyback. And most importantly, you have full-year guidance that soundly beats Wall Street's expectations. After completing our full structural inspection, our verdict is clear. The issues facing Gap are real, but they appear to be temporary, and more importantly, they are manageable. The market's panicked 8% sell-off was a complete overreaction to a weak one-quarter forecast, ignoring the company's full-year strength, its powerful core brands, and its impenetrable balance sheet. Therefore, we believe this is an opportunity. The market has mispriced a structurally sound company based on short-term fear, and that creates a potential entry point for investors who have a longer time horizon. The cracks are there, yes, but they are repairable and the foundation is solid. So we leave you with this final thought. We've presented the evidence from our inspection, laying out both the strengths and the weaknesses of the structure. We see an opportunity here, an opportunity forged from market fear. But now, it's your turn to be the final inspector. You have the blueprints in front of you. Did the market overreact, creating an ironclad opportunity? Or is this sell-off sending a final warning that maybe we're all missing? That's the billion-dollar question you have to answer for your own portfolio. Thanks for joining us here at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.